All right, good afternoon, everyone. Thank you for taking time out of your day to attend. Really, it's our annual applicable large employer reporting, and this is going to be for calendar year 2022, which of course we file in 2023. I'm Corbin Granger. I work with a lot of the compliance issues here at Towne Benefits, and it's a privilege today to be able to talk with you. Generally, how this works is I go ahead and go through the presentation, and if you have a question, feel free to put it in the question box, and we'll get to it at the end. And we also send you a copy of the slides and generally the recording. So with that, as you know, I am not an attorney, nor am I a tax specialist, so we like you to seek out that as you need it. The purpose of these webinars isn't to provide legal or tax advice, but to kind of do the thought process behind the IRS into what you're doing when you're filling out these forms. When we talk about the 1095-Cs, I was an English major in college, and I often think of it as telling that employee's story, but in code. And so when you use payroll systems and when you use other tracking systems to report your forms for you, occasionally, if certain things aren't checked, I've seen penalty letters where it was just a simple mistake, but it generated the letter and it was very scary, you know, give us $50,000, $60,000. So it's always good just to kind of have a little bit of background on what the IRS is after here. So for the 22 forms and instructions, last year actually, there was a proposed rule to extend the reporting deadline to individuals. So that means the 1095-C to your employees for 30 days. Now you can use this if you like. I always encourage employers just to go ahead and take care of it, but the due date for the individual statements is March 2nd, 2023. Now, when you're filing with the IRS, so when you're filing the 1094-C and the 1095-Cs with the IRS, those copies, their due date, if you're filing in paper, is February 28th, or if you're filing electronically, it's March 31st. So just be aware, if you're filing in paper, the due date to provide it to the IRS is before the due date to provide it to individuals. And the IRS does encourage electronic filing. It is only required if for entities that issue 250 or more 1095-C forms. So even though we're talking about the reporting for the 2022 year, I always like to touch on what is going to be happening in the upcoming year. And as many of you probably know, the affordability percentage changes every year. And for the first time, it actually went down significantly. And you as a large employer can determine affordability for one of 3 safe harbors. So these safe harbors are used when an employee waives coverage, right? Because the IRS isn't interested in the fact that they waived. So you'll notice that there's no waiving coverage code on these forms. And the reason is it's the employer's responsibility to prove to the IRS that the employee waived an affordable offer. So you put an affordability code down in line 16, and I'll have some examples later. So in determining if it's affordable, you can use 9.12 of the individual's Box 1 W-2 income. There is a requirement though, if you use this, because it is based on the end of the calendar year income, then it has to apply for the whole year. It isn't done on a monthly basis, it's done against the annual income. Another one, this is good for employers who have a steady workforce, working 40 hours, you know that the incomes aren't going to go down, you can really target it. Now, for employers that, you know, employees don't always work, if it's raining or different times, the other option is 9.12 of that employee's pay rate, or the lowest employee's pay rate for the year, times 130 hours per month times 9.12. So you'll notice with that one, you're limited to 130 hours per month. But with Box 1 W-2, you get the full income. And there are pros and cons to each of them. The last one, which is a really low bar, and so the employer has to subsidize a lot more, is 9.12 of the federal poverty level for the year. So next year it's going to be 13,590. So that would mean an employer couldn't charge more than 103.28 for the lowest self-only cost. But that is really what I like to call a federal fail-safe. So if you use that one, that means it's affordable no matter what happens. So why do we do these why do we file these forms? Well, it's very simple. There are two codes that relate to these penalties, which we know as the pay or play penalties. And so just briefly to review them, it's called the 49 ADHA penalty, but of course we all call it the nuclear penalty. And the reason is it's based upon a failure to offer what we call minimum essential coverage. And I'm sure all of your plans are not only minimum essential coverage, but minimum value to 95% of employees and dependents. And that's triggered if one full-time employee gets a marketplace subsidy. So why is this important? This is very important, and it goes to the issue of tracking your full-time employees. Because let's say you have 100 full-time employees, and let's say they work different shifts, maybe it's a restaurant, and you offered coverage to 90 of them, but in different months of the year, you didn't offer coverage to 10% of them. That would automatically trigger the A penalty. And if there's one person on the marketplace, then you're hit for the entire company. The penalty is 2,880 times number of full-time employees minus the first 30. It's $240 a month. And if you're part of a control group, it's entity by entity, and you have to share that minus 30 full-time employees. The B penalty, which is what we see more typically, is what we call the unaffordable penalty. Now, even though an offer might be unaffordable, it's only triggered if a full-time employee receives a marketplace subsidy because the offer was either not affordable or not minimum value. So I get that question a lot, because if someone enrolls in coverage, right, it doesn't matter if it's affordable or unaffordable. They're enrolled in coverage and they're no longer able to go to the marketplace and receive a subsidy. So the affordability is really, when you think about it, it's really looking at your penalty risk is the employees that waive coverage. And that is a little higher penalty. It's $4,320 per full-time employee that receives a subsidy, $360 a month. And again, it's entity by entity within a control group. If a company could be subject to both, it's going to take the lesser of the two penalties. So let's get into the 1094 and 1095C forms. So what is the purpose? Well, first of all, the 1094C, that is what you call the transmittal form. So I like to tell people it's the cover sheet to transmit the 1095s to the IRS, right? It's much like you use a W-3 form over the W-2s to let the IRS know, like, hey, this is ABC company, we're filing our forms. It's also used for the calculation of the A penalty, because you have to check yes or no if you offered minimum essential coverage as required for the calendar year. And this is where I've seen a number of mistakes. Somebody forgets to check the right box, and you will see an example of this, or they leave it blank. And then when they really did offer coverage, and they actually will end up getting a letter because that's saying that you accept it. So as we're working through the examples, I'll show you what I mean. Now on the 1094C, you can look at part 1. So you have lines 1 through 6, they're pretty standard. On line 18, you're going to indicate the number of 1095Cs you're submitting. So it's best to do your 1095C so you have the number to put on there. And on line 19, each entity is required to have what's called an authoritative transmittal. I don't think this applies, but really you could have companies that do separate divisions and they're both doing the forms. One of them has to be the authoritative transmittal. Hopefully you just have one filing a year, one person at each entity filing the authoritative transmittal. Under Part 2 of 1095C, this is where sometimes it can get confusing on line 22, but let's start with line 20. So on line 20, you're going to complete the number of forms, 1095C, so it's the same question you answered under Part 1. On line 21, you're going to indicate if you're a member of, they call it an aggregated ALE group. We usually refer to it as a control group. And line 22 is the confusing line. And all this does is it represents optional ways to file your Form 1094C. If you don't want to use it, either of these methods, or neither of them apply to you, that's fine. They are not required to be completed. But what is the first one? The qualifying offer method. Now, when you look in the instructions, the first code that comes up is the qualifying offer code. And I've seen clients so many times say, oh, yes, we offer coverage that qualifies, and they use that code. And that's not correct. The qualifying offer method means that the employer is using the federal poverty level safe harbor. So you can't use this unless you're using a federal poverty level safe harbor. So you're restricted to 103.15 for 2022, and you have to offer coverage to the spouse and dependents. So you can't offer conditional coverage to the spouse or exclude spouses. So it's not because it qualifies under ACA, it's because it is a federal poverty level offer. So unless you're using the federal poverty level, this is not going to apply. The 98% offer method is pretty much what it sounds. It was really designed for employers that offer coverage to everybody, not just full-time, but part-time. And what it means is if you offer affordable minimum value coverage to at least 98% of the employees for whom you're filing a 1095C. Now, in most cases, you're going to offer coverage that is affordable to 100% of your employees. Some clients, they choose not to make it affordable for everyone, so you may not be able to say it's affordable to 98%. In this case, you must have offered at least coverage to the dependents, so you don't have to offer to the spouse. And the bonus that you get for this is you actually don't have to complete column B on the 1094C. You have to complete all the other columns, but you don't have to complete column B. And I'll show you what I mean. So here we have part 3. This is column A. Remember I said you have to check either yes or no to offering minimum essential coverage. This is where I see a lot of mistakes. So you can say all 12 months. Now, if you're a new employer and you were in existence, it may not be all 12 months. If you check no, or if you leave this blank, then the IRS assumes that you are accepting penalties. And if one person's on the marketplace, one full-time, then you will receive penalties for the months that that individual is on the marketplace. So please, as you're working with your payroll company, go ahead and double check that and make sure it's filled in correctly, either all 12 months, or you can fill from January to December separately. Section B, column B, that is the column that if you're using the 98% offer method, you don't have to list your full-time employees. Otherwise, you list your full-time employees. And that means these are people that have gone through their waiting period. Those are the people that are eligible for coverage that month. Whether they took it or waived it, they're who you would call full-time that month. They're not new, they're not in a waiting period, they're not in an assessment period, they're actually full-time. The total employee count, of course, is different. you're going to look at the total number of employees that you have employed that month. And they ask that you use a consistent day, like the first day, the last day, the 12th day of the month, or this gets interesting, the first day of the first payroll period in the month, or the last day of the first payroll period, if that falls in the calendar month when the payroll period starts. So I say just do it on the first day or the last day of the month, probably, but whatever works for you. D is what we call, if you're part of a controlled group, then you would check column D. And E is no longer applicable. So here under part 4 is where if you had checked that you were a member of an aggregated ALE group, then you list the other EINs who are also part of that group. So when that other EIN, however many there are, when they do their filings, they're going to include you and all the other EINs. So that's how that works. Unless you're part of a control group, that isn't going to apply. And it doesn't mean all year, perhaps you became part of a control group in part of the year. After you're completing all the pages and you include the 1095-C forms, you want the responsible individual to sign, date, and transmit to the IRS either in paper or electronically. Okay. So it's good to review that form, and especially the yes/no column. So what is the 1095-C? I know you're all burning to hear the answer to that question, and this form is used to report to the IRS offers. Remember, we don't report waivers, we report offers of coverage to every employee that qualified as full-time for 1 or more months in the calendar year. So you could have an employee that qualified as full-time for 3 months in the calendar year and then left, but you would have to complete the 1095-C for that individual for the year. Or if it's self-insured, to show enrollment and coverage of employees and non-employees. So if that offer of coverage is not affordable, that's where the IRS is going to catch it, and it's going to be on line 16, and we'll go through that. Plans that are fully insured for the entire calendar year only complete parts 1 and part 2. Plans that are self-insured for any month in the calendar year must also complete part 3. Now that's for individuals, so that means it's including spouse and dependents that are enrolled in any month of the year. So let me repeat that. If you're fully insured for the entire year, you only complete part 1 and part 2. But if you're self-insured, you have to include part 3. So let's say you have a non-calendar year plan that renews every year in November. So in 2022, you had a fully insured plan from January through October. And in November, you became self-insured. So starting in November, you would have to complete part 3 for those individuals that were enrolled on the self-insured plan. Let's look at a 1095-C. So the first page actually includes part 1 and part 2 of the form. And then we're going to go ahead and kind of break it up and go through the examples and the codes. The third page is part 3. And that is where you report covered individuals with self-insured coverage. Now, if anyone out there has an individual coverage HRA, you would also report that. Please don't think that if you have an HRA, you have to report it. It's only the individual coverage HRA. It's very specific coverage. You can't offer group health insurance to individuals that you're offering this to. People are blocked from getting subsidies, so it's not popular, but that's the only HRA that would apply. If you are fully insured for the entire calendar year, leave it blank. So let's look at part 1 and part 2 in a little bit more detail. Okay, so on your 1095-C, it's pretty self-explanatory. Part 1 is where you fill out the employee information, and on the left side, and then on the right side, you're going to complete your employer information. Under part 2, if you see on that top line, it says employee offer of coverage, employee age on January 1st, and plan start month. You do not have to complete the employee's age or the zip code unless you have an individual coverage HRA. I am going to assume on this line nobody has an individual coverage HRA. You do, however, have to report the plan start month. So that does apply. So again, you do not report the employee age, you do not report the zip code unless you have an individual coverage HRA. So I've said that again, only individual coverage HRA and the plan start month. Now they want 2-digit codes, so it's going to be 01 to 12 for the calendar month when the plan year begin. Now, if you have an employee that is eligible middle of the year, right, you still put the plan year. You don't put, the month that the individual is eligible for coverage. Now, if you had a short plan year and you had 2 plan years that could apply, then just put the earliest month down. And if there is no health plan, which you should have a health plan, you're on the line, coverage would be offered as 00. Again, line 17, skip, 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 unless you have an individual coverage HRA. What are the codes? So there's line 14, there's line 15, and there's line 16. Line 14 is what we call the offer of coverage code. So you're either going to show 1H, no offer, or another code to show an offer. You never leave line 14 blank, even if the employee was not employed by the employer. So what does that mean? What does that mean? It means you would put 1H for not offering, and then you'd use the code to say the employee wasn't employed that month. So it's going to tell a little story. You enter the code that applies for the month. Now, if you have the same code that applies for all 12 months, you may use the all 12 months box. The coverage must be valid for the entire month. And if the coverage terminates before the last day of the month, if the offer of coverage terminates before the last day of the month, or coverage terminates before the last day of the month, like let's say somebody leaves the 15th and the coverage ends right then the employee does not have an offer of coverage for that month and code 1H would apply. So here are the codes. I highlighted 1H because I think people get confused about that and they think, well, that's a bad code. It shows they didn't offer coverage. But you're going to show on line 16 why you didn't. They either weren't employed, they were in a waiting period, there's some reason why that occurred. When you use an offer code, it's going to reflect the highest tier of coverage offered. The exception is 1A. If you're using the federal poverty level safe harbor and you make an offer to dependents, you can use 1A. Most companies are probably going to use 1E if they offer to the full family. You may have where you offer just to employee and dependents, not to the spouse, or offer a conditional offer to the spouse. So 1H should be paired with the appropriate 2 series code, and I think this really helps. So 1H, no offer. Why? 2D, the employee is in a limited non-assessment, what we call a waiting period, or it's their first month of employment. They didn't offer coverage. Why? 2B, the employee is part-time, they changed to part-time, or it's the month of termination. If the employee terminated before the end of the month and was not enrolled until the end of the month, or if the offer stopped before the end of the month. 2A is if the employee was not employed any day in the month. So you generally use 2B, the month of termination, unless the employee was enrolled in the plan for the entire month, or you switch to 2A for the first calendar month the person isn't employed at all. Here are the individual coverage HRA codes. I am not going to read through them. We include these in the slides just for purposes of knowledge. And we also like people to be able to, look at them again later on, but we're not going to belabor this. Okay, line 14, you put the highest tier you offer. You don't put what the employee took, you put the highest tier you offer. So in this instance, the employee was offered a plan for all of calendar year 2022 that's going to cover his entire family, and that's going to be 1E. I think a lot of clients will end up using 1E. Line 14, if your offer wasn't for all 12 months. So here's an example. This is where you're going to have a combo. You're going to have a 1H, and then you're going to have an offer code. And for purposes of simplicity, we're always using 1E. You may actually use a different code, but we're going to be using 1E. So Tom is not an employee in January. 1H, no offer. He's hired by the Levon Home Company. I don't know if there are any band fans out there. On February 10th, 2022. 1H, he's not eligible the first day of employment, so he's not offered. Tom is eligible for an offer of coverage the first day of the month following date of hire. So that's going to be March, and the offer is going to be 1E. So he wasn't offered for 2 months, and then he was offered for the rest of the year. So now let's look at line 15. Line 15, again, does not show what's being deducted out of the employee's paycheck necessarily. It reflects the monthly premium for the lowest self-only cost for the lowest plan offered. Lowest self-only for the lowest plan offered. Now, if you have age rates, then line 15 is going to differ based on what the employee pays for each age rate band. So just keep that in mind. If you have composite rates, you should be able to use the same composite rate for all employees for the lowest self-only cost, okay? If you have a non-calendar year plan and your rates change, so for example, January through October, your cost of self-only lowest cost is $125 a month, and then November through December, it changed to $150 a month, then line 15 is going to have to change. But the ones who have to do the most calculations and remind your payroll companies is if you have age-rated premiums, they're going to need to know what is the lowest self-only cost for that age band. And remember, if you have employees that have waived coverage, then that's going to be the cost that would have been to cover them because they're not actually taking coverage. Okay. You enter the amount, including cents. So if the employee contribution is 0, you put 0.00 and you don't leave blank unless you use the 1A code. And line 15 has to be blank. That's your qualifying federal poverty level offer. If the contribution was the same for all 12 months, you can use the all 12 month box. But if you have a non-calendar year plan and your employee contribution changes during the year, then you're going to have to complete it for every single month. So in this example, Tom is offered a PPO plan at $175 a month and an HMO for $125 a month self-only. You use the lowest cost plan self-only, and so that would be $125. We actually don't know what Tom took, and that's not relevant for this reporting. It's just the $125 self-only that you report. Now, line 16 codes. I have a little thing that I like to say, which is line 16 is your friend. This is the line that I see skipped most of all, and I don't know why. Sometimes I guess it's just the payroll company may not have known what to put in there, and they put nothing in there, and that is never, ever, ever a good idea. As long as you are eligible, there are some cases where you're not eligible to put a code there, especially if it's unaffordable, but in most cases it should be affordable, and line 16 is your friend. So line 16 are your safe harbor codes. So remember when I talking back in the beginning of the presentation, you can use box 1 W-2, rate of pay, or federal poverty level. You use those codes for full-time employees that waived coverage, because that says to the IRS, hey, Corbin waived my plan, but it was affordable based upon her rate of pay, or it was affordable based upon my box 1 W-2, or it was affordable based upon the federal poverty level. So that safe harbor code is intended to explain to the IRS so they can't assess a penalty. Because if I ended up on the marketplace, I have to file these certain returns, and this form is going to conflict with that. I will tell you, if there is a conflict, what we have seen is that they go to the employer first and have them prove affordability, what they issue a potential penalty letter. And generally that's pretty easy to contest as long as everything is together. Line 16 should always be completed unless there's nothing that applies, meaning if your offer was not affordable or if you just offered MEC. There is a case if you use the federal poverty level, line 16 also can be optional, but I just always stress line 16, please check it, please make sure it's completed. So for example, a full-time employee waived an unaffordable offer. So this is an example where you couldn't use it. A full-time employee waived an unaffordable offer. Well, you can't use the safe harbor code and say it was affordable because it wasn't. So it has to be blank for that employee, and you may end up with a B penalty if the employee gets a marketplace subsidy. All right, so let's work through a couple of examples here. So going back to Tom, he was not employed in January. So line 14 is 1H, line 15 is blank, and line 16 is 2A. That means he was not employed at all that month. Now, Tom was hired in February on February 10th, but he's not eligible for coverage. So line 14 is still 1H, line 15 is still blank, but line 16 is 2D. That means a waiting period. In March, Tom is eligible for coverage and he enrolls. So line 14 is 1E, line 15 is 125, the lowest self-only cost, and line 16 is 2C. That's the code for enrolling. So you see, it does kind of tell a little story. He wasn't employed, he's in a waiting period. Oh, he elected coverage. So let's look at one where the employee does not accept an offer of coverage, and let's look at some changes, you know, how we can play with that a little bit. So we have a full-time employee that waives an offer of affordable coverage. And in this case, we're using the rate of pay safe harbor. So the employer has done the work. They've realized that Tom's pay rate, it is affordable. And so they're going to use that safe harbor. So same thing, 1H2A, 1H2D, March 1E, 125. This time he didn't accept it. So now we need to use the rate of pay affordability safe harbor because we know it's affordable against his rate of pay, and it's 2H. Okay. Now, what if Tom terminates his employment and his coverage ends that day? So line 14, so let's see. So he terminates in April. So we've got 1H2A, 1H2D. Then we go to March, 1E, 2C, he enrolled. In April, actually that should be a 1H2B. And then all through it should be 2A. Okay, and this assumes we've already put 125 in the code there. Now, for employees that have terminated, a COBRA offer is reported as 1H. Why is that? because once someone has terminated employment, they're no longer a full-time employee. So offering them COBRA doesn't apply. Unless the plan is self-insured and you have to report whether or not they've had COBRA. If COBRA is offered because you have a reduction in hours and that employee is still full-time under ACA, so they're in a stability period, that could generate the B penalty if the cost of COBRA is not affordable and the employee receives a subsidy. So for example, this is if you're measuring people and they're in a stability period. So here, Tom is in a stability period as full-time, but he reduces his hours. Well, reducing his hours in a stability period does not change his full-time status. The employer allows him to take COBRA, even though he's still full-time for ACA until the end of the stability period. And therefore, if Tom chose a subsidy, then it would generate the B penalty for the employer. So what I like to say is if you have employees that are in a stability period as full-time, don't change the status until the end of the stability period when it shows that he is indeed part-time. Now, there's a break in service rules. So rehired employees can be treated as a new employee for ACA and apply a new waiting period. So normally if someone does not have a 13 consecutive week break in service or 26 weeks for institutional where no hours are credited, they are not considered a new employee and you cannot apply a new waiting period. So they have to have at least a greater than 13 week consecutive break, 26 weeks for education. So when you have your seasonal employees, you generally want them to have a greater than 13 week break in service so that they're never ever achieving full-time status. You kind of use the rule of parity. I haven't ever seen it be used because it's very difficult. A break in service of at least 4 weeks where no hours are credited and the break in service exceeds the employee's prior employment period. So for example, somebody works for 3 weeks and then they have a break in service for 4 weeks. Well, that's greater than the length that he worked. So you can consider them a new employee. Most clients, however, use the 13 week. All right, so let's go through and look at part 3 for self-insured. Part 3 for covered individuals. This applies to an applicable large employer offering self-insured coverage. So you have to report all individuals covered. So that's the employee, the spouse, the dependents, and anyone on COBRA. So the employee and family members covered included for the months enrolled in coverage on the same 1095-C. You put the name of the covered individual, you put the Social Security or the taxpayer ID in B. You only complete line C if there's no taxpayer ID number. You should always have a social or taxpayer ID number. And if the individual was not covered for all 12 months, you don't use the all 12 month box. You just check the amount of months that the individual was covered. So, So for example, we have Tom Smith, his social, he was covered all 12 months. Sally Smith, her social, she was covered all 12 months. They had a baby, congratulations, and the baby was born in September. So the baby only has September, October, November, and December checked. Okay, and that's because even if he didn't have coverage for the whole month, as long as he had coverage one day in that month, that counts as a full month for that type of reporting. All right, so I've gone through this a little bit, and I know probably a lot of you are very knowledgeable about the reporting, but I'm going to go ahead and open it up to questions right now to see if anybody has a question. And I'm not going to show the screen so that we don't see people's questions in the presentation. Okay, well, I don't see any questions. I hope that means that this was understandable for you. really is a privilege to be able to assist all of you, and you have my information or your broker's information. If you need any assistance, and I look forward to, I turned the wrong thing on. Look forward to helping you anytime. It's a privilege. And also, I'm wishing everyone a very, very happy holiday and a happy new year. Okay, thank you so much.